The problem in not knowing what your business is worth is multifaceted. And as I mentioned, the general problem is that if you don't know how to measure value, you don't necessarily know how to best increase value. So it's all part of being a proactive value optimizing business owner.
What you don't know is costing you commas and zeros. Welcome to the Owner's Profit Playbook. I'm Pat Mancuso. Most entrepreneurs think their biggest challenge is growing revenue, but the real problem is the profit leaks hiding inside their business. On this show, we break down the strategies, structures, and financial blind spots that separate struggling operators from truly profitable businesses. Because building a business is one thing, but building a business that creates wealth, that's the real playbook.
Welcome to the Owner's Profits Playbook, the show where we help small to medium-sized business owners uncover their blind spots, missed opportunities, and silent profit leaks that are costing them commas and zeros that they should be keeping. I'm your host, Pat Mancuso, the strategic advisor, tax mitigation expert, and creator of the Owner's Profit Playbook. After decades of working with entrepreneurs at every stage, I've learned one thing. What you don't know is costing you commas and zeros. And the one thing costing companies big is not knowing their own company's valuation. They can tell you what they do, how they do it, and some can rattle off their financials, but if pressed to assign a value to the company they've worked tirelessly to build, they have no idea. So let's jump into today's episode. Scott, welcome to the Owner's Profit Playbook. I want to jump in right now. You were involved in the founding of BizEquity, a platform that frankly changed the game for small and medium-sized businesses. What I'd like to do is start off with you sharing your story. How did you get into the world of business valuation, and what led to the creation of BizEquity?
Oh, okay. Thank you for having me here with you today. Well, I guess you could say career-wise, I have always been somewhat of a generalist, meaning I have degrees in economics and in international finance, but also German, the language German. And I then spent 3.5 years in a PhD program teaching economics, which again is kind of big picture, general view. And along the way, I worked as an internal auditor, which is also kind of a general overview, auditing the entire company, all the operations. That was with Motorola Shearing Plow, 2 Fortune 200 companies in Europe and Asia is where I did my auditing. And then I taught economics full time, but wanted something more. So then I became a business broker, middle market specialist for 6 years. And that's when I first really kind of grew attached to the prospect of becoming a business appraiser. And so in 2001, I took all the necessary steps to obtain the certification. Now I have four of them, and it's been a fantastic career. BizEquity actually began in the year 2006 under a company called Advanta, a credit card company for small businesses. And after a couple of years of doing the groundwork, they had reached out to me to help them build the algorithm, et cetera. And right as we had began to launch it at a conference in Las Vegas in 2008, the stock market crashed. And then, of course, the Great Recession came, and Advanta was a victim of the crash. They didn't get saved, so to speak, and they went into bankruptcy. So the real BizEquity that we know today started in 2010 when Mike Carter, the longtime CEO and primary founder, bought the assets out of bankruptcy and started to build a professional company that has grown over the past 15 years now. So he brought me in to fix up the algorithm because, he had showed it a couple of times and it was kind of embarrassing him. And so I took my valuation skills to BizEquity, and we built out what is ultimately the most complete and accurate online business valuation platform. It's been a great ride, and we had successful capital raises before selling completely in 2019 to American City Business Journals.
Oh, wow.
And they, of course, published the 43 business journals across the country, like the Phoenix Business Journal, et cetera.
Right.
And so they've been a very good partner as well. And in fact, we are just about to launch a brand new initiative called the Private Company Valuation Index, and it's on the website of American City Business Journals, and it tracks the average values, asset sale value, equity value for companies in the 53 economic segments that comprise and mirror the private economy.
Wow.
And the overall index is weighted based on each industry's contribution to the overall GDP. And
Very exciting.
Yeah, it is very exciting, and we're sending out a press release in a couple of days. And so anyway, long story short, I'd always been interested in the big picture, and business valuation is ultimately a big picture project where literally every discipline that you can think of could be relevant in a given valuation.
Yeah. And we're going to drill down into that, Scott, and what a great journey. So let me ask you a couple of questions in this portion of our conversation. Most business owners don't know what their company is worth. Why is that from your perspective?
Well, I would say for many, it's a matter of indifference, and there's no compelling reason, so they believe, to know what their value is until there's some urgent need to find out, like illness, retirement, just burnout, 7-year itch.
Sure. Well, and we'll probably delve into this a little bit further, but that's actually not a great time to find out valuation. That's more of a need. And, we're going to talk, I'm sure, about the proactivity or the proactive part of why this tool is so important in the utilization of it. So let me ask you this. Why do traditional valuations take weeks and cost thousands and thousands of dollars from your perspective?
Well, first of all, it's a profession, and it's a group of people trying to make the best living that they can. So they're going to charge what the market will bear. And as compared to using the BizEquity software tool, which is not a formal appraisal and can't be used in every situation, a formal appraisal is a major undertaking that requires seemingly endless documenting. And there are different variations in the report type and size that can limit the price, but even a basic what we call calculation report these days now costs $5,000, $6,000, $7,000. Full appraisals, $10,000, $15,000, $25,000, depending on the nature of the company, the purpose of the valuation, et cetera. For example, SBA valuations can be cheaper, $4,000 to $5,000.
Sure.
But estate and gift tax appraisals, anytime there's litigation or high prospects for potential litigation, the fees will be higher, the reports will be longer and more in depth, and therefore they'll cost more and take longer to write.
And that makes perfect sense at that time. And yet, what I see is certainly in the usage of the program so far is this is really a tool in the journey, if you may, to that end result. Would you agree that that's a fair assessment?
100%. And I would go even further to say that it is the ultimate planning tool,
Right.
not just for business owners proper, but for advisors of all types, such as yourself. Um,
And that's why, Scott, I'm so excited, about our ability to use the tool, but also what it's going to provide to owners. And we're going to talk a little bit about that again. I'm backloading all of this because I really do want to lay the foundation. So let me ask you this. One of the biggest blind spots I see is business owners don't know their evaluation. We talked about it earlier. They know their revenue, they know their expenses, and in some cases, they know their profit, not as many as I'd like to have know it. But valuation, they generally don't have an idea until it's too late.
yeah,
So when we look at that, what are the dangers in that? In other words, what is at risk when an owner doesn't know what their business is worth?
yeah. Well, let me start by adding to the reason why business owners aren't aware of what their businesses are worth. And it's something that I explain to every business owner that I discuss a valuation report with. There is no such thing as the value of a company, period. Value will change depending on, for example, what's valued. When an owner goes to sell their business, they can either do an asset sale or a stock sale. And they each contain a different bundle of assets and liabilities and risks, and therefore the value is different.
The values are different, sure.
Value differs over time. Every valuation has literally dozens of underlying assumptions, any one of which would change would cause the value to change. And that's why when you hire 5 appraisers to value a company, you're going to get 5 results that have a range to them.
Right.
And a typical range could be, let's say, 1.75 million to 2.25 million. If you hired 5 appraisers, gave them all the same documents, you're going to have that range. Maybe the mean mid-range is 2 million, but you're going to have that variation plus or minus 10% easy, sometimes 100%. The IRS versus taxpayers, 500%.
Yeah.
So there is no such thing as devalue. So that's part of the reason why it's maybe off-putting to those who don't know. But the dangers of not knowing are or result in essentially lost value.
Isn't that ironic? The opportunity to not know your value actually impacts you losing value because you don't know your value.
That's right. Yes. And that can, you can lose value in many ways, but the most general way is based on the fact that if you don't know what your business is worth or how to assess its value generally, then you are not going to fully understand what might be the best steps to take to increase the value in the future. So it really should be a proactive journey.
Right.
Every business owner should devote some time to basic business valuation knowledge and or rely on advisors who do have that knowledge.
Yeah, I think that's so important, Scott. I was recently looking at a firm and to purchase, and the owner was not. Let's just say this: the revenues were lower than they should have been compared to the industry, And
Yeah.
so they were raising revenue, and their understanding or their belief maybe was, I'm raising the revenue, so the value's instantly there. And the fact of the matter is that's not necessarily true, right?
You mean that their revenues were growing?
Yeah, even though the revenues were growing, it's not like an instantaneous value deal. And that was the thinking, right? And
Well,
so yeah, that makes perfect
absolutely,
sense.
absolutely not necessarily the case that higher revenues mean higher value.
Right.
Now,
Right.
for some industries, revenue multiples are essential. Like
Right.
if you're selling a bookkeeping business, you have a book of business, and uh, that book of business will be sold based on a multiple of revenues, subject to an earnout. But it's not a ceteris paribus all other things equal proposition that higher revenues equal higher value.
Right.
Ultimately, if I were to summarize, the primary determinant of value is profitability. The problem in not knowing what your business is worth is multifaceted. And as I mentioned, the general problem is that if you don't know how to measure value, you don't necessarily know how to best increase value. So that's uh, it's all part of being a proactive value optimizing business owner. Understand the valuation basics, because it's not just a matter of revenue growth.
Sure.
Profitability is the ultimate uh, metric for optimizing business value, and every dollar of incremental cash flow that accrues to the owner is going to lead to a multiple of that amount increase in value. So
Right.
that's something every owner should internalize, this what we call the size effect. But it doesn't necessarily happen for revenues. It's profits, higher multiples, higher value. But other problems without knowing what your business is worth is you potentially could leave money on the table when you're selling.
Yeah.
You could overpay when you're buying. Um, if you don't take the time to know what your value is and then compare the alternatives of an asset sale with an equity sale and the tax ramifications thereof, that could be very costly, because there are ways and means and tactics in the deal structure to minimize uh, taxes.
Hmm.
And without knowing what the actual value is, you're not going to be able to properly assess that tax ramification.
Absolutely.
So many issues with not knowing or understanding the value of your company, which is, by the way, typically their single largest asset. So, why not take the time to learn those basics
Yeah.
and run with it?
Yeah. Well, it's interesting, Scott, that you say that, because, the next part of our conversation is, that's exactly what I tell our clients is it's the least understood thing that they have as their biggest asset. So let's shift gears a little bit. I want to just delve into a little bit of the BizEquity premise, if you may. What makes BizEquity different from traditional valuation firms? And I know you're going to come up and you're going to talk about some technical things, if you may, because that's your deal, right? You just love that. And in our conversations previously, I really enjoyed that about it. But what makes it different? What makes BizEquity different?
Well, I would say the primary difference is that we have literally struck the balance between simplicity and complexity in an online platform that was designed to mimic the same steps that I take as a professional appraiser, valuing a company for whatever purpose
Mm-hmm.
in the role as a certified business appraiser. So at the end of the day, we have managed to create an accurate, reliable, software-based valuation tool that will, in almost all cases, generate a result that falls within that range we talked about earlier of what 5 appraisals would generate given identical facts. So we've walked the tightrope between making it too simple to lose out on credibility, to making it too complex to where people will not use it or not understand it. But in short, it's primarily a market approach driven algorithm whereby each company is valued by way of multiples of revenue and discretionary earnings, which is essentially an adjusted EBITDA. So all of our multiples are industry specific, size adjusted, and company specific risk reflective. So as you go through the 7-step process and enter data, we are making internal assessments of those numbers. And you get to certain steps and you move sliders up and down, like, what would happen if the owner left business? What's the percent of revenue from top 3 customers?
Sure. Yeah.
All the way through the report, the actual final multiple is going up and down depending on what those metrics are as entered. And the end result is an asset sale value. So we take multiples of revenue and discretionary earnings, apply those to weighted metrics of earnings and revenue, and that generates what we call an asset sale value. And so remember, I said when you sell your business, you have 2 choices.
2 choices.
Asset sale value, equity value.
Right.
Asset sale value means something very specific. It's not the value of all the assets. An asset sale value, quote unquote, is the value of the firm's inventory, fixed assets, and all the intangibles.
Right.
Trade name, customer base, goodwill, covenant not to compete, the operations of the business. But the asset sale value does not account for cash, receivables, or liabilities. That's where the equity value comes into play. So our equity value is equal to the asset sale value that we just described based on multiples of revenue and earnings. The equity value is equal to the asset sale value plus cash, receivables, other liquid financial assets, minus all the liabilities.
Right. Well, here's what I like, what I've been impressed with so far is how the tool and without, again, it's so technical behind the scenes, but for the user, like me as an advisor, consulting businesses and the business owner going through the process, easy is an overstatement, if you may, but it really is, in going through it, it really is an amazing tool with all the technicals behind it, right?
Yeah.
And so, go ahead.
Well, I was going to say, it is user friendly, and will be increasingly so as we add the ability to download tax documents automatically or financial statements if you have QuickBooks, for example.
Right.
So that will help with the simplicity.
Well, so Scott, let me just jump in here and kind of tease for at the end. The excitement for me getting you on this podcast is we've got an option to offer this tool, and we're going to talk to that at the end. But we really have 2 options. We have a very simplistic option, and there's no cost on that. And then we're choosing as an advisor to actually offer the upgraded version that in theory would be thousands of dollars to business owners. And we're going to offer them to business owners that free of charge as well as our gift to them. And just because we feel that having this knowledge and having a more succinct number on that evaluation is so important. So let's talk. You and I were talking, and we've talked in the past about how shocking our owners.
By the way, let me add that
Go ahead.
that is a fantastic offer.
Yeah, thank you. Well, and it really goes to the passion that I have, which is, when you think about most business owners, they get into business, owning a business, and no one ever understands. I had this conversation with somebody the other day. Nobody ever understands. The business owner lays awake at night, some cases wondering if they're going to meet payroll, how they're going to meet payroll, how are they going to borrow cash to take advantage of an opportunity. And those things happen every day. And the entrepreneur doesn't wake up in the morning and put a memo out and complain to everybody that they laid awake at night wanting, understanding how to meet payroll. Yeah. But the thing that I am passionate about is that the business owner does this for 10, 15, 20 years and gets to the end. And that end might be they get a tap on the shoulder. That end might be they want to live a different life, whatever that end looks like for that owner. And they're shocked at that time that their value isn't what they thought it was. Yeah. And that's really because they had no idea along the way. So give me, if you can, I want to have you share, if you can, an experience where you had something like that, where a business owner discovered what they had in value and how much that changed the direction or the trajectory of their company.
Yeah. Well, first of all, our website has a number of success stories of how the tool's been used to help either advisors or business owners, both. And one of the more common types of feedback are as simple as, wow, I didn't realize my company was worth that much. And a lot of that is due to ignorance. Not the best word, but
well, actually, it's they're busy. Their heads are down, and they're and you use the word ignorance, and I'd say they ignore the things that are important because they're focused on the things that they think are critical at that time.
That's right. That's right. But the offer that you're making is phenomenal, not just because it's free, but because if a business owner takes that step, that could turn out to be the best move of their business owning career.
Yeah.
And as you know, shortly, the BizEquity tool will be adding 2 new modules, in a sense, to the front and to the end. We're going to be adding a value optimization module,
right,
which will foster the conversation between advisor and business owner on, well, what exactly can we do to increase the value?
Right.
So there'll be concrete, actionable, to-do recommendations based on the unique traits of a given company.
Right.
And at the same time, we're adding an exit readiness module, which is designed to, in effect, ensure that the business owner has the proper documentation in place. For example, if there's multiple owners, you need to have a buy-sell agreement, or you're gonna end up potentially in a protracted legal battle if one or more of the partners decide to sell and you don't want them to sell, and so on and so forth. So if you are in a business with multiple owners, you really do need to make sure you have a buy-sell agreement in place. And take those related steps to facilitate a potential transaction, both procedurally and financially.
Right. Well, Scott, one of the things I've personally experienced is the buy sell agreement issue, and then the protracted part of that process. But I've also, watched where having this valuation conversation reshapes strategy. It reshapes where tax mitigation comes from. And so it's all because the owners had a real number to work with versus what they think. I mean, let's take the flip side of it. I can't tell you how many people think their business is worth 5 million and then it's not worth 5 million, and they're making decisions for their lifestyle down the road based upon 5 million. The other thing I find interesting, and you probably experience this as well, is they sometimes they do not understand, and it's not because they're not smart, because they're very smart, but they don't understand when they exit the business that 3 million they were making today is now taxed at a different rate because they don't have the business deductions that they had. So they thought they were going to be, taking home the same money. There's so many things that come into this.
Yes.
So Scott, I'm going to shift gears a little bit on you. And so Scott, one of the biggest things that BizEquity does is beautifully breaks down the drivers of a company's value. And there's 7 of them that you all have defined. So let's touch on those a little bit if we could.
Okay. Well, starting with the big picture, I don't think there's any doubting that the primary determinants of value are size, profitability, and growth. Size, profitability, and growth. How large is the pool of earnings? What's the profit margin, the EBITDA margin, or the pre-tax profit margin? And how fast is the company growing? So, for example, within the software realm, SaaS companies, there's something known as the rule of 40. And what that means is that a desirable SaaS company will have a combination of EBITDA margin and annual growth of 40% or higher. So could be a EBITDA margin of 30% and growth of 10%. Or an EBITDA margin of 10%, growth of 30%. You get to that 40%, that's an attractive company. So that's bandied about in the SaaS world all the time. But if you go to look at actual data, there is one particular source, GF data, which monitors what they call the quality premium. And what that boils down to is that companies with higher growth, higher profitability, generally speaking, sell for higher multiples. Now, within the BizEquity tool itself, there are many different factors that will affect that actual final multiple. Even, it's not just customer concentration or owner dependence, but it's also things like what is the relative magnitude of the firm's fixed assets versus industry norm. That'll have a modest impact. Same thing with inventory and intangible assets. So literally from start to finish, 7-step process. As the user works his or her way through, the actual final multiple will go up or down depending on all these factors that affect value.
Yeah. And here's again, we were looking at this firm, and one of the things, it's not right or wrong, it's just the reality is things like databases, right?
What type of company was this?
It was a financial company, an accounting firm.
Okay.
And, and smaller firm, 15 employees, but certainly a valuable firm from our perspective. But when you started, looking at these things, and the reason I bring that up is I think, we've been talking about value and valuating companies on the owner side, but this is really also on the buyer side, right? Because the tool is both valuable on both sides of the table, if you may. Because if I'm the owner and I don't have it maximize the company, then I'm a buyer, and if I'm educated, I'm going to see that like those things. So they're connected. Is what I was trying to
Other
get
side of
to.
the coin. Other side of the coin.
Right. Yeah.
Yeah.
Yeah. No, the thing, and we talked about the revenue drivers, and you brought those, in different perspectives in this conversation. And I think it's just so important. One of the things I talked about earlier is my passion, as a business owner my entire life, and owning multiple businesses and exiting some, and having great success, and exiting some, and then exiting some and not having great success. I wish I would have had this tool earlier on. And I wish my consultants and my advisors had brought it to me earlier on. But here's why I'm super passionate about it now is when you look at the number of baby boomers that own businesses that are exiting or are perceived to exit in the next 10 to 15 years. And I don't know, Scott, I would say 80 to 90% of them have no clue on their value. They still have time to get that information to
That's
make
true.
some changes to impact the rest of their life after they exit. Would you
That's
see
very
that
true.
to be true?
Absolutely. And I would go even further and say that even if you wanted to sell in the end of 26 or the end of 27, there's enough time
Right.
to do some significant house cleaning, so to speak.
Right.
And I mentioned that because there's a definite consensus now among deal makers, whether they're investment bankers, M&A advisors, commercial banks, uh, any uh, entity that has a research team looking into what's the future hold. There's a general consensus right now that 26 will be a good year for M&A activity.
Yeah.
And whereas the last year or so, the sellers have been reluctant to let go of their quality businesses.
Sure.
Things were kind of muddled and slower and uncertainty, but that's pretty much changed with the tax bill done, the tariffs settled down, uh, interest rates coming down. So there is this very positive vibe right now among M&A deal makers that 26 could be a good year to sell.
Yeah, I've read that as well, Scott. And that absolutely, it's common conversations out there right now. So, Scott, every owner listening right now should hear this. If you don't know your value drivers, you cannot intentionally increase the value of your business. That's why knowing these numbers, it matters just as much as knowing your taxes and financials. And so, as we kind of come towards the end, so Scott, one of the most powerful parts of this partnership is that listeners can get a full BizEquity valuation, normally tens of thousands of dollars at no cost. And so everyone listening today can simply go to https://Mancuso, MANCUSO, cg.bizequity.com. And we'll post that in the show notes as well. And again, what we shared is you've got two options there. You can get a quick valuation with putting in just some basic information, or we can take you through the 10-step process and we can pull all that information out from that and give you that range that Scott talked about. So, Scott, let me ask you this as we kind of come to the end here. Why is it important running that valuation right now versus not later so important?
Well, I would say that's simply a matter of optimal planning. You've got kind of one shot to get things right when the time comes to sell. And I always recommend that business owners proactively take some time regularly to learn about business valuation.
Right.
And that could be understanding what exactly are discretionary earnings. How are they calculated? How are they used in a given transaction? And why do they matter so much?
Right.
And what can you do to increase those discretionary earnings? So proactively educate yourself on basic business valuation. And that can all take place at the BizEquity website by going to our Success Center.
Sure.
There's a wealth of information there. We even offer a course which would grant a certification to an advisor, and completely online, but it includes a textbook that I wrote on business valuation. And if all you did was take that book and open it up for 10 minutes a week, it's going to help you look to the future, contemplate what would be the optimal way to enhance business value,
Yeah.
whether
Well,
it's increasing revenue or decreasing risk.
right. Right. Well, Scott, it ties into, one of my mantras, if you may, which is what you don't know is costing you commas and zeros. And you just shared with me something I don't know about that certification. So now I've got something to add to my process here, if you may. So, Scott, I always end our sessions on what I call the 2-minute drill. It goes around and kind of ties into our playbook theme. So I'm going to just rapid fire, just looking for very quick answers from you. What's the biggest misconception owners have about their valuation?
About their valuation?
About their valuation. What's the biggest misconception they have?
They don't understand exactly what is included in that number.
Yeah, so if they don't understand what's included, then they have no way to understand how to impact it.
No, and equity value is different than an enterprise value, which is different than an asset sale value. So if
Makes
they don't,
perfect sense.
yeah, if they don't
So
understand that, that's a problem.
What's that?
If they don't understand what's included in that number,
Right.
that prohibits them from optimally planning.
Makes perfect sense. Next question. What's the one thing owners should fix immediately to increase their value?
I would say reduce the day-to-day dependence on the primary owner.
That's a big one.
Yes,
Yeah.
big one. And that can be a rude awakening for some business owners who haven't looked into valuation for a particular type of business, theirs.
Right.
When they discover that, because literally they are the business, you can't sell yourself and walk away.
Yeah. Just even the relationships, right? Even the 15 to 20-year relationships with customers who have done business with you 3 or 4 or 5 times. I mean, that is absolutely a great point. Should valuations be done annually, quarterly, or why?
Well, I think that depends on where you are in your life span of a business, but I would say at a minimum annually.
Mm-hmm.
And by doing it annually, you can presumably develop goals and objectives to work on over the course of that year and reflect on at the end of the year.
Well, if you said differently, Scott, if you don't do it annually, then you can't use it to plan your goals, which means then when you get to the end of the next year, there's no way for you to know, did you increase the value if you're not benchmarking it, right?
Yes.
Yeah,
Even if the revenues went up, maybe your value went down.
exactly. Last question before we end here today. One piece of advice every owner needs to hear. What would it be from you?
Find and utilize the very best advisors available.
Yeah, great advice. Great advice. Well, Scott, this was incredible. First, thank you for shining a light on what I believe is the biggest blind spot in the business world for business owners, which is not knowing their valuation. To everyone listening today, take one action from today's episode and let it be this. Go to our website, Mancuso, MANCUSOCG.BizEquity.com. Get your free evaluation. Know your number, because your business is your biggest asset, and it's likely that you don't know the value, and that's what's costing you commas and zeros. Thank you for joining us on the Owner's Profit Playbook. I'm your host, Pat Mancuso. Scott, thank you for being here today. We absolutely appreciate your time, your resources, your experience. Oh my gosh, it's been amazing. So thank you so much.
Thank you. I thoroughly enjoyed it, and I'd love to do it again sometime.
Well, we will definitely get you back. I appreciate the offer.
Maybe annually.
Oh, I love that. Oh my gosh. Might even be able to do this quarterly because everything's changing so rapidly.
That's
if you found today's episode of value, please subscribe, share the episode, and help other business owners take control of their wealth. We'll see you the next time, where we turn insight into income and blind spots into breakthroughs. Take care, everyone.
If you're serious about building a more profitable business, make sure you subscribe to the Owner's Profit Playbook so you never miss an episode. And if you know another business owner who could benefit from this conversation, share it with them. To learn more about how we help business owners uncover hidden opportunities and strengthen their financial strategy, visit MancusoCG.com. And remember, what you don't know is costing you commas and zeros.